Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now I'm going to start the problems on capital budgeting. Last three videos I have completed the theoretical part of investment decisions, unit number 4. Now we are applying the techniques of evaluating the capital budgeting proposal. So last video I have explained you different techniques, tools and techniques are available with the finance manager to evaluate the capital budgeting proposal. 2 traditional methods and 3 modern methods I have explained. The traditional methods are PBP, payback period, and average rate of return ARR. And the 3 modern methods are NPV, net present value, profitability index PI, and internal rate of return IRR. So all these techniques now we are going to apply in the problems. In examination, frequently they will ask the problem on this capital budgeting. So watch the video till the end. If you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject Financial Decision Making 2. Select the videos of unit number 4, Investment Decisions. Be perfect regarding the concept of capital budgeting and the techniques for evaluating capital budgeting proposal. Now before starting the problems, I expect my viewers to have a printout of the problems which I have given in the link under my description. Without having the problems, you cannot understand all the explanation of these problems. Now take the screenshot of the solutions of the first few problems, then I'll explain every point. Now, the first problem. Calculate the payback period for the following projects, each requiring a cash outlay of rupees 1 lakh. Suggest which project is acceptable if the standard payback period is 5 years. First problem is on PBP. The payback period means the time required to get back our investment. How many years are required to recover our investment money? That is called payback period. The lower the payback period, the better it is. Now, here in this problem, the standard payback period given by the management is 5 years. The cash outflow is 1 lakh. And year 1, 2, 3, 4, 5, 5-year cash inflows are given. For project A, the cash inflows are 30,000, 30,000, 30, 30, 30, constant. For A project, the annual cash inflows are constant. For B project, the annual cash inflows are 30,000, 40,000, 20,000, 10,000, 5,000. So it is fluctuating. So one project, constant cash inflows. The second project, fluctuating cash inflows. So how to calculate the PBP? Already theory I have explained. Now I am applying that in the formula. Calculation of payback period, project A. The annual cash inflows are constant. So we apply the following formula to calculate the PBP. The formula PBP is initial investment divided by constant annual cash inflows. This formula of PBP we apply only if the annual cash inflows are constant. A project, it is constant. The PV of cash outflow, the present value of cash outflow is 1 lakh. And the annual cash inflows are 30,000. So 1 lakh divided by 30,000, 3.33 years. 3.33 years is the PBP for project A. Similarly, project B. The annual cash inflows are not constant. So we have to calculate the cumulative cash inflows. So year 1, 2, 3, 4, 5. The cash inflows are given 30,000, 40,000, 20,000, 10,000, 5,000. It is fluctuating. When the annual cash inflows are fluctuating, we calculate cumulative. Cumulative cash inflows. First year 30,000, same 30,000. 30,000 plus 40,000, you'll get 70,000. 70 plus 20, 90,000. 90 plus 10,000, 1 lakh. 1 lakh plus 5,000, 1 lakh 5,000. So we have calculated the cumulative cash inflows. Now, how much is the cash outflow given in the problem? 1 lakh. The cumulative cash inflow is equal to 1 lakh at the end of 4 years. Now you see, refer the cumulative cash inflows. 30,000, 70,000, 90,000, 1 lakh. So in which year the cumulative cash inflow is 1 lakh? Fourth year. At the end of the fourth year, the cumulative cash inflow is 1 lakh. So 1 lakh rupees cash outflow and cumulative cash inflow is also 1 lakh at the end of fourth year. So 4 year is the PBP. Now we got the PBP for A project is 3.33 years. The PBP for B project is 4 years. Then if the standard PBP is 5 years, then both the projects are acceptable. However, if the projects are mutually exclusive, then project A is better. The standard PBP given by the management is 5 years. And both the projects are having the PBP less than 5 years. That means both the projects are acceptable. Both the projects are acceptable. However, if the projects are mutually exclusive, that means any one of the project has to be accepted, then we prefer project A because the PBP is less. B project 4 years, A project 3.33 years. So 3.33 is less than 4. So project A is better. Come on, now we'll start problem number 2. A project cost rupees 25,000 and has a scrap value of 5,000 after 5 years. The cost of the project is 25,000. Life is 5 years, and at the end of the 5th year, when the life expires, there is a scrap value of 5,000. The net profit before depreciation and taxes for 5 years period are expected to be 5,000, 6,000, 7,000, 8,000, 10,000. These are the profits given before depreciation taxes. That means we have to calculate after depreciation and after taxes. You are required to calculate the ARR, average rate of return, assuming 50% rate of tax and depreciation on SLM, straight line method. So we have to calculate first of all the annual depreciation as per straight line method. First problem we have done on PBP, payback period. Now second problem we are doing on ARR, average rate of return. So calculation of ARR. First of all, we need the annual depreciation as per straight line method. The formula for depreciation is cost of the asset minus scrap value divided by life. The cost of the asset is 25,000. Scrap value is 5 years. No, sorry, 5,000. And the life of the asset is 5 years. So 25,000 minus 5,000, 20,000. 20,000 divided by 5, 4,000. So annual depreciation, every year depreciation remains same, 4,000. Now we need profit after tax. In the problem, profit is given, but before depreciation and before taxes. But we need profit after taxes. So how to calculate profit after taxes? We have to make the table. What is the table? See here. Year 1, 2, 3, 4, 5. CFBT stands for cash flow before tax. So the cash flow before tax is given 5,000, 6,000, 7,000, 8,000, 10,000. Same values I have taken. Now depreciation. Next column is depreciation. 4,000 every year, constant. Now next is PBT, profit before tax. How to calculate profit before tax? Profit cash flow before tax minus depreciation. CFBT minus depreciation will get PBT. So 5,000 minus 4,000, 1,000. 6,000 minus 4,000, 2,000. 7 minus 4, 3. 8 minus 4, 4. 10 minus 4, 6. These are the PBT, profit before tax. Now tax is at the rate of 50% given in the problem. The income tax is 50%. 50% of PBT. So 1,000 50%, 500. 2,000 50%, 1,000. 3,000 50%, 1,500. 4,000 50%, 2,000. 6,000 50%, 3,000. So we got the tax. We need PAT, profit after tax. So from PBT, deduct the tax. PBT minus tax is equal to PAT. So 1000 minus 500 is 500. 2000 minus 1000, 1000. 3000 minus 1500 is 1500. 4000 minus 2000, 2000. 6 minus 3, 3. We got the PAT. For calculating ARR, we require PAT. Now in this table, we have calculated PAT. Find the total PAT in 5 years. The total PAT in 5 years is 8000. But we need average PAT. So average PAT is equal to total PAT divided by number of years. The total PAT 8000. Number of years 5. So 8000 divided by 5, 1600 is the average PAT. Now we need average investment. The formula for average investment is 1 by 2, half into cost plus installation minus scrap value. This cost plus installation minus scrap value, put it in bracket. Then outside the bracket plus scrap value. Add up the scrap value. To find out the average cost of the depreciable asset. Depreciable asset means after deducting scrap value. So here cost is 25,000. There is no installation, 0. Scrap value is minus 5,000. And close the bracket. Outside the bracket, scrap value 5,000. So 25 minus 5, 20,000. Half of 20,000 is 10,000 plus 5,000. 15,000 is the average investment. So we got average PAT, we got average investment. The formula for ARR is average profit divided by average investment into 100. That is 1600 divided by 15,000 into 100. We'll get 10.67%. This is called ARR. The first problem we have done on PBP, second problem on ARR. Now see the third problem. The finance manager of a company has the following data. Operational life of the project is 4 years. The earnings before depreciation, interest and taxes are expected to be 44,000, 62,000, 78,000, 86,000. The 4 year is the life. Depreciation is on straight line basis and tax rate for the company is 25%. The investment required in the project is 1,92,000. This is the cost of the project. Find the ARR of the project. Exactly similar to the previous problem. We have to find out the ARR. The formula for ARR, average PAT divided by average investment into 100. That is the formula. But in the problem, PAT is not given. Profit after tax is not given. Profit before depreciation and tax is given. CFBT is given. Just like the previous problem, we have to convert the CFBT into PAT. Right? So first we calculate annual depreciation as per straight line method. Cost minus scrap by life. The cost is 1,92,000. There is no scrap value. Previous problem scrap value was there. Here no scrap value, 0. Divided by life of the project is 4 years. So 1,92,000 divided by 4, 48,000 is the annual depreciation which remains same every year. Now calculation of PAT. So 4 year the data is given CFBT, cash flow before tax. It is 44,000, 62, 78, 86. The same thing I have copied. Depreciation 48,000 every year remains same. Now PBT, profit before tax. CFBT minus depreciation. So CFBT minus depreciation. So 44,000 minus 48,000. You are getting minus 4,000. There is no profit. There is loss. Because negative you are getting. 44 minus 48 is minus 4. So 4,000 negative. 62 minus 48, 14,000. 78 minus 48, 30. 86 minus 48, 38,000. So we got PBT. Now we need the tax. The tax rate is given in the problem 25%. So tax 25%. First year there is no tax because there is no profit. There is a loss. Income tax is a tax on profits. If there is a loss, there is no tax. So just put a dash. Second year, 14,000 is the PBT. Now calculate 25% tax. So 25% of 14,000, 3,500. 25% of 30,000, 7,500. 25% of 38,000, 9,500. So we got the tax. Now PBT minus tax is equal to PAT. So here PBT minus 4,000 minus 0 is minus 4,000. The profit after tax is minus 4,000. Then 14,000 minus 3,500, 10,500. 30,000 minus 7,500, 22,500. 38,000 minus 9,500, 28,500. Take the total. Here negative minus 4,000. So 28,500 plus 22,500 plus 10,500 minus 4,000. You will get 57,500 is the total PAT. Now total PAT divided by number of years will get the average PAT. So average PAT 57,500 divided by 4, 14,375. Now we need average investment. Same formula what we have applied in the previous problem. 1 by 2, half into cost plus installation minus scrap. Close the bracket. After the bracket plus scrap. In this problem, we don't have installation cost and we don't have scrap value. Just put 0. Half. Cost is 1,92,000 given in the problem. Installation 0, scrap 0, 0. So 1 by 2 into 1,92,000, you'll get 96,000. Average investment 96,000. The formula for ARR, average PAT divided by average investment into 100. So average PAT 14,375, average investment 96,000 into 100. 14.97%. This is the ARR. So totally 3 problems I have explained. One problem is on PBP. Second and third problem is on ARR. Now fourth problem. A limited company is considering investment in a project requiring a capital outlay of rupees 2 lakh. So company is considering to make an investment in a capital project requiring 2 lakh rupees. This is the PV of cash outflow. Forecast of annual net cash flow CFAT. CFAT stands for cash flow after tax. Previous problem we were given before tax, but now directly it is given after tax. No need to make the table. Directly we can take cash inflows. Are as follows. Year 1, 2, 3, 4, 5. CFAT, first year 50,000, second year 50, third year 50, fourth year 50, year 50. Constant. Every year 50,000 cash inflows we are getting. Calculate net present value, NPV, taking the cost of capital as 10%. This is the first problem where we are going to calculate net present value, NPV. This is very, very important. I advise you, whenever you watch the video, always keep a calculator, notebook, pen beside you and note it down. Write it down, whatever points, important points I'm explaining, particularly the formula. Now from here onwards, the problems are a little bit complicated. In this problem, the initial investment is 2 lakh rupees. The cost of the project is 2 lakh. And after investing 2 lakh rupees, the company expects a cash inflow of 50,000 rupees every year. First year, second year, third year, fourth year, fifth year. 5 years is the life. Every year 50,000 cash inflow. We are required to calculate the NPV at a cost of capital of 10%. That's it. Now see carefully. Calculation of net present value. For calculating NPV, we need PV of cash inflow. Present value of cash inflow. Right? How to calculate? First year, year column. 1, 2, 3, 4, 5. Second year cash inflows. That is CFAT. Given in the problem. 50,000 every year. Now we need present value factor. PVF. Stand for present value factor. Now how to find out? It is not given in the problem. So for finding out the present value factor, 2 methods are there. The first method is PV table. In any textbook, you will find the PV factors table. So always keep ready this PV factor table, right? And by referring this PV factor table, you can be able to ascertain the value of PV factor. Otherwise, The alternative, if you don't have the PV factors table, then with the help of calculator, simple calculator, you can be able to calculate the PV factors. Both the methods I will show you. In PV table, two tables are there. One table is the present value of 1 rupee, and the second page it is given present value of annuity of rupee 1. So one page annuity and one page PV of rupee 1. Now we require PV of rupee 1. At what percentage? 10%. So here on the first page, the present value of rupee 1, 1%, 2%, 3%, like that up to 10%. And first column year is given. So against first year you can see 10%, 0.909. So second year, against second year 10%, you can see 0.826. Third year again you will see 0.751. And fourth year 0.683. Last fifth year 0.621. These are the values ready-made available in the table. You can refer the table and take the values. Otherwise, if you don't have the table, use the simple calculator. Simple, not scientific. Simple calculator. On simple calculator, how to find out the PV factors at 10%? The formula is 1 divided by 1 plus R to the power of N. 1 divided by 1 plus R. R means rate of return. 10%, 0.1. 10% means 0.1. 10 divided by 100, you will get 0.1. So 1 plus R, so 1 plus 0.1. I will show it here. The formula is 1 divided by 1 plus R to the power of N. This is the formula to calculate the PV factors, where R is the rate of return. Here rate of return is 10%. 10% means 0.10. So here 1 divided by 1 plus 0.10 to the power of 1. Because N is equal to 1 year, then 2 year, then 3 year. In place of N, we can write 1 year, first year 1, second year 2, third year 3, like that. So 1 plus 1.1 means 1 divided by 1.10 to the power of 1 is equal to 0.909. Now you can check 1 divided by 1.10 is equal to 0.909. Same thing we got. Now second year we need 1 divided by 1.10 to the power of 2. 1 divided by 1.10 to the power of 2. So in this case, is simply what you have to do is, for first year what you have done, 1 divided by 1.10 is equal to 0.909. For 2 years if you want, simply press is equal to. Simply press is equal to, you will get 0.826. So we got 0.826. Third year, 1 divided by 1.10 to the power of 3. Simply press is equal to, you will get 0.751. You will get 0.751. Fourth year you want, simply press is equal to 0.683. Fifth year you want, simply press is equal to, you will get 0.621. So what you have to do? If you don't have the calculator, on the simple calculator, 1 divided by 1.10 is equal to, you press. So first year you will get 0.909. Second year, just press is equal to, you will get second year. Again is equal to third year. Again is equal to fourth year. Again is equal to fifth year. 0.621. That's it. In this way we have calculated the PV factors, because this is the first problem. That's why I am explaining time again and again. Now 0.909, 0.826, 0.751, 0.683, 0.621. Now multiply the cash inflow with PV factor. 50,000 into 0.909, 45,450. 50,000 into 0.826, 41,300. 50,000, 0.751, 37,550. 50,000 into 0.683, 34,150. 50,000, 0.621, 31,050. Take the total of cash inflows. PV of cash inflow total. You will get 1,89,500. So 1,89,500 is the total PV of cash inflow. Now net present value, NPV. The formula for NPV is PV of cash inflow minus PV of cash outflow. The PV of cash inflow is 1,89,500, we got it. PV of cash outflow will be given in the problem. It is given 2 lakh. Here it is not 2,000, it is 2 lakh. So 1,89,500 minus 2 lakh, you will get minus 10,500. So NPV is negative, minus 10,500. So if you have to give the suggestion, we'll give the suggestion the project should not be accepted because it is giving a negative NPV. That's it. This is the first problem on NPV. Now, for your information, I am showing the alternative method. The PV of cash inflow, the present value of cash inflow can be calculated either by making the table or by using a formula. But formula can be used only if the annual cash inflows are constant. If these annual cash inflows are constant, then we can find out PV of cash inflow either by making a table or applying the formula. If the annual cash inflows are fluctuating, then compulsorily you have to make the table. You cannot apply the formula. So the formula can be applied only if annual cash inflows are constant. Here annual cash inflows are constant. So if annual cash inflows are constant, the PV of cash inflow can also be ascertained by the following formula. The formula is PV of cash inflow is equal to constant annual cash inflow into PVAF. PVAF means present value of annuity factor. Present value of annuity factor. This is the second table. At the into PV of annuity factor at the rate of 10%. 10% is the rate against 5 years. The life is 5 years. So if you refer the table, two tables we have. First table PV of rupee 1, second table PV of annuity of rupee 1, right? Now PV of annuity of rupee 1, 5th year, in the row of 5th year under 10%, you will get 3.791. If you refer the table, 3.791. This is the PV of annuity factor at 10% against 5 years. Refer the table, right? So we have taken here 3.791. Multiply 50,000 into 3.791, 1,89,550. This 1,89,550 is the PV of cash inflow. Now you compare. By making the table, we got 1,89,500. By applying the formula, we got 1,89,550. So there is a difference of 50 rupees. That difference is arising due to rounding off. We have restricted up to 3 digits only. Actually, it is not 3 digits. It is more than 3 digits. We have restricted up to 3 digits for our calculation purpose, for our simplification. That's why small 50 rupees difference we get, ignore it. So remember the point in the coming problems, if the annual cash inflow are constant, better to use the formula and use annuity instead of table. The table will be useful only if the annual cash inflows are fluctuating. One more point. If you don't have the table, you can find out the annuity factor also on the simple calculator. How to calculate? I'll just make a demonstration. The 10% rate, so 1 divided by 1.10 is equal to 0.909. This is the first year annuity at 10%. Now second year annuity, what you have to do is put this 0.909 in memory. There is a button here, M plus, memory. So press M1. It is in memory, right? Now is equal to second year. Again you put it in memory. Then again third year. Again put in memory. Fourth year, again memory. Fifth year, again memory. So 5 times you have saved the amount in the memory. Now you want the total. Press M1. So 3.791. Recall the memory. MRC. The button is MRC. Press MRC, you will get the total. 3.791. So without having the table, I have calculated the PV factors, all these PV factors, and also I have calculated the annuity factor. Simply press it under memory. You keep it every time, you keep it in memory, and after completing all 5 years, press recall the memory, MRC. So when you press MRC, you will get the total 3.791. That's it. So this is the end of fourth problem. Now fifth problem. See the problem number 5. Calculate profitability index from the following data. Cost of the project is 10 lakh, cash inflows first year 2,80,000, second year 3,60,000, third year 4 lakh, fourth year 5 lakh. Cost of capital is 10%. Last problem we have calculated NPV. Now this problem we are going to calculate profitability index. There is not much difference in calculations of NPV and PI. Almost similar. Here NPV, PV of cash inflow minus PV of cash outflow. For PI, PV of cash inflow divided by PV of cash outflow. We are dividing in PI. Here we are subtracting. That is the difference. Now calculation of PV of cash inflow. Year 1, 2, 3, 4, 4 years. And cash inflows are given first year 280, 360, 400, 500. Cash inflows are given. Now PV factors at the rate of 10%, just like the previous problem, 0.909, 0.826, like that. Just now I have explained. Now multiply this cash inflow with PV factors, you will get PV of cash inflow. Add up all the PV of cash inflow, we will get the total PV of cash inflow 11,93,780. Now profitability index, PI, the formula is PV of cash inflow divided by PV of cash outflow. We are dividing. Here we have subtracted. Now PI formula, PV of cash inflow by PV of cash outflow. So 11,93,780 divided by 10 lakh, 1.19. So 1.19 is the profitability index. The decision rule is, if the profitability index is more than 1, accept the project. If the profitability index is less than 1, reject the project. If the PI is exactly equal to 1, indifferent. That is the rule in PI. That's it. So in this first video on problems on capital budgeting, one problem I have explained you on PBP, 2 problems I have explained on ARR, 1 problem I have explained on NPV, and lastly 1 problem on profitability index. Inshallah, we'll continue the problem in the next video.